Well, hello everyone. It's Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and welcome to my Sunday Deep Dive. In this weekly video, we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Now, as my longtime readers and listeners know, one of my favorite things to do is to challenge investing dogma and so-called received wisdom told to us by the financial media oftentimes. Now, what I mean by that is there are some ideas, some concepts, and intermarket relationships that are almost assumed to be true, mainly because they're so often repeated as rules of thumb. However, when you actually dig a little deeper and look at the actual data, they're dead wrong. Or at a minimum, the situation is a lot more nuanced and complex than the simplistic rules about markets you often hear. Now, debunking investment myths and crushing popular narratives like this can actually be very profitable because while the investment crowd, the unwashed masses, so to speak, are following the wrong playbook, you understand the actual trends underway. So perhaps you've heard talking heads on financial TV tell you that utilities underperform when treasury yields rise. Or maybe you recall the notion, which is very popular back in 2022, that rising rates are bad for long-duration technology stocks. Now, the idea there was that technology stocks are valued based on distant future cash flows and growth, earnings growth, rather than earnings or profits or cash flow they're expected to generate over the next year or two. Thus, the theory goes, when yields rise, it means that the discount rate applied to future cash flows or profits also rises, making them worth less in net present value today. Simply put, in rising rate or yield regimes, investors are willing to pay less for distant future earnings, which impacts the valuations paid for those same long-duration growth names, technology being the most obvious sector. There's also the notion that banks and energy stocks benefit from rising rates, and real estate companies like the real estate investment trusts benefit from falling rates. It's something I'm frequently asked about, especially when the financial media is sort of full of scare stories about a hawkish Fed or spiking treasury yields. However, is any of it actually supported by the actual data, by the actual history of rates, yields, and economic cycles? Let's dive in. Here's how I decided to test this rate sensitivity narrative. I retrieved data on all 11 S&P 500 economic sectors. These are, in this case, really the sector spider ETFs, dating back as far as I possibly could find it. For most of the sectors, that means I was able to get data back to December 22nd, 1998, while a few sector ETFs are newer, including communication services. That's the XLC ETF, and real estate, which is XLRE, is a symbol for that ETF. Now, I also retrieved data on the S&P 500 Spider ETF, the SPY, the SPYs, and the actual KBW Banking Index. The symbol there is BKX. And, of course, 10-year Treasury yields, U.S. government bond yields. Now, to start, I decided to look at rolling 5-week alphas for each sector. Now, what that means is alpha is simply a measure of a sector ETF's performance, total returns, including dividends, right, relative to the S&P 500. So this is a more valid measure than straight sector total returns. That's because in a strong bull market, most sectors in the S&P 500 are likely to get pulled higher by the rising market tide, regardless of changes in interest rates. So the opposite is going to be true of bear markets like 2007 to 2008 or 2022. What we really want to know with this is if a particular sector tends to outperform or underperform the broader market S&P 500 when, in this case, the 10-year Treasury yield is rising or falling. We want to know if trends in the Treasury bond market actually can provide a guide as to which sectors of the stock market you should buy, or even more important, which sectors might be dangerous groups to avoid given the interest rate backdrop. Now, don't worry, I will get to absolute sector returns in various interest rate environments a bit later on in this video. But let's start with the relative returns, the alphas. To start, I took these daily rolling 5-week sector alphas, right? and regress them against the contemporaneous, happening at the same time, 5-week change in 10-year Treasury yields. Now I calculated those Treasury yield changes in basis points, and a basis point is 1/100th of a percent, 0.01%. Now here's the result on your screen right now. This table lists all the sector ETFs and indices, their symbols, the total number of observations in the data set, and the start date for the regressions. Now this is 5 weeks after the first available data point for each ETF, so I could calculate 5-week changes, right? The column labeled beta per 100 basis points, or BPS, shows the sector alpha performance relative to the S&P 500 over 5 weeks, regressed against changes in the 10-year Treasury yield. Now specifically, it's the percentage change in alpha per 100 basis points in Treasury yields. That's 1 full percent yield change. So look carefully at that column. For technology, the top row, for example, the beta for the full historical sample since the late 90s, back to 98, is positive 0.009%, which means that for every 1% change in 10-year Treasury yields over 5 weeks, tech stocks tend to outperform the S&P 500 by 0.009%. 3 points, right? First, that's a tiny number for the full sample, especially when you consider it's based on a huge move in 10-year yields, plus 1%. Second, the sign here is positive, which totally goes against the narrative I talked about to you earlier that tech stocks tend to benefit from lower rates. Historically, actually, tech stocks have tended to outperform the broader market when 10-year Treasury yields rise, not underperform, as the conventional so-called wisdom would have us believe. Third, just look at that R-squared value of 0.5%. That means that changes in 10-year Treasury yields explain only about 1/2 of 1% of the performance of technology stocks over 5-week holding periods since the late 90s, which means that 99.5% of returns have nothing to do with yields. Now, as I've often said, R-squared values on financial variables do tend to be low because the data is noisy, and that's even more true when you look at daily returns as we're looking at today, daily pricing data. However, that R-squared value is just too low in this case to have any real value or predictive power. Now for utilities, there's a negative sign on the beta, you can see here, which confirms that the group does tend to underperform the S&P 500 when rates are rising. However, much as with technology, the beta of negative 0.053%, well, it's very low in absolute terms, and the R-squared isn't even 10%. It's about 9.5%. Now, real estate has the largest negative sign and the highest R-squared. However, the absolute value of the beta here is still tiny at negative 0.064%. And while the R-squared looks more interesting, just shy of 20%, it's worth noting that the data for XLRE, that's the real estate ETF, only stretches back to 2015 compared to the late 90s for technology, utilities, and most of the other groups listed in the table. Now, as I'll explain here in a moment, the most interesting part of this deep dive I did isn't that any sectors stand out as correlated to higher or lower Treasury yields. It's that the correlations change over time. It's a question of economic and interest rate regimes rather than the simplistic absolute truths about rate sensitivity and those rules of thumb you often see presented in the media. In short, there are fewer different economic and market regimes since 2015 than since the late 90s. It's a matter of time, right? So this table likely inflates the importance of rates to the real estate sector and communication services relative to the other groups and indices in my table because they have shorter pricing histories. So let's turn to the rolling 2-year correlations. The 2-year betas of these sectors with respect to changes in Treasury yields. This will give us a better idea of how these correlations change over time. Now we're looking at the same regressions, 5-week changes in Treasury yields and 5-week alphas, again, relative performance of a sector to the S&P 500, except instead of calculating the beta and R-squared values for the full sample size, We're looking at the data over rolling 2-year look-back windows. So let's start with technology and that XLK technology ETF. The rolling 2-year beta windows begin in February 2001 because that's 2 years after the start of the data set in early '99. And as you can see, technology's performance compared to the S&P 500 was positively correlated to rates, and the strength of this correlation grew steadily through the first few years of this chart. Now recall that the Greenspan Fed was hiking rates into mid-2000, and then it began aggressively cutting rates in 2001 as it became clear the economy was headed for recession. As a result of the recession and bust in the stock market, right? 10-year Treasury yields fell sharply from over 6% in 2000 to under 4% by 2002. At the same time, technology stocks were underperforming the S&P 500 as the sector reeled following the blow-off top in the NASDAQ in March of 2000. So that generates a positive beta between tech and rates. Rates are falling and tech is underperforming. They were moving in the same direction, down. I'd argue the positive correlation at the time had little or nothing to do with rates or treasury yields. Tech stocks performed very well in the period from late 1998 through early 2000 as 10-year yields soared, right, from 4.104% to 6.867%. And the Fed was hiking rates at this time. This was the final melt-up stage of the tech bubble of the late 90s. And the talk at the time was that growth in the internet had decoupled from the broader old economy, right? Stocks like Cisco Systems were leading the market higher, even as most stocks were going down. Market breadth had started to deteriorate as far back as 1997. When the bubble finally burst in early 2000, a lot of these erstwhile tech darlings were trading at true nosebleed valuations, even quality stocks like Cisco Systems trading at over 200 times trailing earnings, and get this, 29 times revenues. That left them a ton of room to fall. The NASDAQ 100 was down 82.9% from the peak in 2000 to the ultimate trough in 2002, and Cisco was down a whopping 88%. In fact, it didn't actually reach highs above those 2000 highs until the last couple of years. Of course, a stock trading at 29 times revenues is certainly valued on growth prospects, right? Distant future cash flows and earnings, not near-term profits. Yet long-duration tech stocks of the day got zero help from dramatically lower interest rates and yields in the early 2000s. 10-year Treasury yields clearly weren't the driver of that cycle, and the long-duration rate sensitivity narrative that everyone talked about in 2022, it didn't work at all in the early 2000s. Quite the opposite, in fact. It's also notable that for much of the period from 2005 through 2017, technology alpha had no consistent correlation to changes in 10-year Treasury yields. For the most part, tech was mildly positively correlated to yields. In other words, rising 10-year Treasury yields tended to be bullish for tech relative to the S&P 500, but the actual betas were modest. It's only starting in 2018 that we began to see some more meaningful swings in this metric for technology. First, a big slump in tech stocks relative to the S&P 500 as yields rose into late 2018. Now, some readers or listeners may recall that late 2018 brought a short yet sharp sort of mini bear market in the S&P 500 there in the fourth quarter of 2018. And then, of course, we saw an increasingly negative beta for tech from the spring of 2020 until early April of 2022. That's because the Fed's extraordinary monetary accommodation starting in early 2020, a combination of unprecedented quantitative easing, QE, and slashing short-term rates to zero, that catalyzed a plunge in 10-year Treasury yields and an outsized rally in technology stocks. There's your negative correlation. Not surprisingly, this negative correlation reached an all-time low in 2022 of negative 0.084% for tech, right around the time we started to hear about tech's long duration and corresponding interest rate sensitivity, negative interest rate sensitivity. Fast forward to today, and the story is the exact opposite once again. Indeed, on a trailing 2-year basis, the correlation of tech alpha and 10-year Treasury yields is the most positive in over 20 years. So tech has been tending to outperform the S&P 500 when yields rise, not when they fall. That's the opposite of the long duration technology stocks underperform the S&P 500 when yields rise thesis we heard about so much a couple of years ago. I think it's also instructive to look at the R-squared value for these rolling 2-year correlations. So here you go. The R-squared is also known as the coefficient of determination. An R-squared of 25% in this case, for example, would tell us that 5-week changes in 10-year treasury yields explain about 25% of the contemporaneous 5-week relative performance of technology stocks to the S&P 500. Now, as you can see, for most of the period covered by my chart, changes in treasury yields just aren't a particularly important driver of how tech stocks perform relative to the broader market S&P 500. There really are only 2 exceptions. There's the 2001-2002 era, when the R-squared climbed to around 25% as tech stocks underperformed and yields fell. That's a positive beta. And then there's the 2020 to 2022 period of negative beta, when the R-squared rose to just shy of 45%. That's a period when yields first plummeted and tech soared in 2020, 2021, followed by a period when yields rose and tech underperformed into 2022. There is no powerful, consistent relationship between treasury yields and technology sector alpha over time, and certainly no valid rule of thumb that you should look to sell tech when yields rise or buy when yields fall. So how about utilities? Now this is a classic high dividend income-oriented group, right? The theory here is that if 10-year treasury yields are rising, the income available in risk-free government bonds is also rising. And that would tend to make the yields available in, not risk-free, at least, utility stocks less attractive. As I noted earlier, utilities have a very modest tendency to underperform the S&P 500 over 5-week periods where yields are rising. The full sample beta for a 100 basis point rise in 10-year yields is negative 0.053% with an R-squared of just 9.5%. So while the notion that utilities are rate sensitive is accepted as irrefutable market dogma, the truth is that yields are at best a minor factor in how utilities perform relative to the S&P 500, explaining less than 10% of sector alpha since the late 90s. Now, let's look at the beta over rolling 2-year correlation windows for the utilities and that XLU ETF, just as we did for technology and the XLK ETF. What's interesting here is that the 2-year correlation between utility alpha to the S&P 500 and 10-year yields hit maximum negative in October 2016. Now, why this is so remarkable is the R-squared value for the correlation soared over 60% right at the same time. Now, here's that chart of the XLU R-squared real quickly. Again, this high coefficient of determination means that changes in treasury yields explained a little over 60% of utility performance relative to the S&P 500 in the 2 years leading up to the autumn of 2016. However, this episode just doesn't fit the traditional rate-sensitive argument for the group. Not at all. Recall that the Fed, which was then under Janet Yellen, was starting to talk hawkish by 2015 and pushed through the Fed's first quarter-point rate hike since 2006 on December 16th of 2015. However, while Yellen was talking about raising rates, the market was worried about economic growth and the potential for the economy to buckle if the Fed were to hike too aggressively or start to moderate all the monetary easing put in place starting during the 2007 and 2009 Great Recession crisis years. So while the Fed sounded hawkish, right, 10-year yields actually fell due to the economic soft patch from a little over, and the yields came down from a little over 2.5% in September 2014 down to around 1.37% at the July 2016 lows. Now, the broader stock market essentially marched in place, right? The S&P 500 was in a trading range, and there were a handful of short yet severe corrections along the way, including in the summer of 2015 and again into early 2016. In this environment, utilities outperformed a fragile flattish stock market, and falling treasury yields. I'd argue, however, that this was less about yields falling and investors seeking a high yield proxy than it was about fear. The 2015 to 2016 episode had real teeth, right? The Fed had to reverse course after the December 2015 rate hike. Oil collapsed, China wobbled, and the S&P 500 had two sharp corrections, as I just said. The utilities outperformance was partly income seeking, right? But probably more about capital preservation and the fact that utility earnings were considered somewhat defensive in the face of weaker economic growth. The yield correlation, well, it was almost incidental. Both bonds, rising treasury prices and falling yields, and utility outperformance, well, they were symptoms of the same fear trade. And in my view, the 2017 experience seals the deal on this view. Yield spiked after Donald Trump was elected president in November 2016 on the view that the incoming Trump administration would be pro-growth. Recession fears subsided accordingly. Through 2017, the broader market enjoyed its lowest volatility rally since the early 1960s. And 10-year yields were essentially flat through the year around that 2.4% level. Now, utilities rose in absolute terms in 2017, but they underperformed the S&P 500 by about 8.5%. Again, when viewed through the rate-sensitive prism, flat yields should mean utility stocks perform roughly in line with the S&P 500. They didn't because waning recession fears prompted a massive rotation out of more defensive sectors and into groups like financials. Now, the XLF ETF was up 20.7%. And technology, the XLK ETF I covered earlier, well, that was up more than 33%. These are more levered to the growth and risk on trade, those XLK and XLF sectors, and then compared to XLU. And just look at the R-squared regression since 2016, again on my chart. For the past almost 10 years, changes in 10-year treasury yields have become less important in determining the relative importance of utilities. I suspect a combination of factors are behind that, including, quite possibly, that some utility stocks are now correctly viewed as major beneficiaries of the growth in demand for electric power in the United States due to the rapid build-out of data centers and growth in industrial demand as well. Yet, you still hear some talking heads on TV trotting out the tired line that when rates rise, you should look to sell utilities. That's just not backed up by the data. And what really makes me, quite frankly, a little angry is that this simplistic advice, so-called advice, and rate fear trade are actually costing real investors like you and me money, especially investors looking to grab some sleep easy income and dividends from low volatility groups like utilities in their portfolios. So at this juncture, you might be wondering, are yields of any use whatsoever in determining relative sector performance? Well, my research confirms that it's more about yield velocity than direction. Take a look. To create this table, I looked at 5-week changes in the 10-year treasury yield across our rolling 2-year correlation windows. I also examined the standard deviation of 5-week changes in yields over rolling 2-year windows to determine if large moves higher or lower in rates have an impact on sector alphas. Again, returns versus the S&P 500. Now look at technology as an example. Large yield drops, and that's a yield fall of 2 or more standard deviations, right? You get a return, a beta of plus 0.17%. So that's the mean alpha, 58% hit rate, win rate. Tech outperforms on violent yield crashes, presumably because those tend to coincide with growth scares, right, for the economy, where tech's defensive secular earnings growth and quality is repriced higher. Now, moderate yield drops, yield falls of greater than 1 standard deviation and less than 2 standard deviations, tech actually has a negative 0.34 mean alpha. Tech underperforms the S&P 500. Which is counterintuitive to the long duration narrative and suggests moderate bond rallies and rate declines often coincide with rotations into more value and cyclical groups. Now, placid bond markets, where the rise in yields is less than 1 standard deviation up or down. You get a mean alpha of plus 0.37% with a 55% hit rate. Tech quietly outperforms when rates are just drifting, which is the dominant regime. That's approximately 70% of all observations in my data set. Now, a moderate yield rise, plus 1 to plus 2 standard deviations, you get a mean alpha of plus 0.60%, a 58% hit rate, right? Tech outperforms in a moderate rising rate environment, completely demolishing the long duration narrative. Large yield rises, plus 2 or more standard deviations, well, here you go, negative 1% mean alpha, but only a 32% hit rate. Tech gets genuinely hit, but only when the rate move is a true shock, not a mild upward drift or sideways or mild down or deeper down. The data often backs up, my hypothesis that outperformance for utility stocks amid sharp drops in rates is more about buying defensive groups amid concern over the health of the economy than it is about rate sensitivity. Look at the sectors that show the strongest alpha when yields see a large drop, like healthcare, staples, and utilities. These are all low beta sectors when we define beta in the traditional capital asset pricing model or CAPM framework. Now that's the tendency for sectors to move relative to the S&P 500. For example, a stock with a CAPM beta of 0.5 would tend to rise by 0.5% when the S&P 500 rises 1%, defensive. In contrast, a stock or sector ETF with a beta of 1.5 would tend to move faster than the S&P 500, rising 1.5% in response to a 1% rise in the broader market. Over the entire time period I studied since the late 90s, the CAPM beta for consumer staples is 0.57%. It's 0.69% for utilities and 0.72% for healthcare. Those are all defensive groups. Here's a summary table for you on the screen. This data supports my thesis. The fact that groups like utilities, healthcare, and staples tend to outperform the S&P 500 when rates plummet, large yield drops, and underperform when yields rise significantly has little or nothing to do with sensitivity to rates. Rather, it's that in most environments since the late 90s, yields rise when the economy is recovering from a recession or economic growth scare. So slow-moving sectors with low betas will tend to rise in absolute terms, but still underperform the more sensitive, economically sensitive S&P 500. In contrast, when 10-year yields are plummeting, right, that's a signal that the market is worried about growth or a potential looming recession. Naturally, defensive stocks with betas below, let's call it 0.8 or so, they would tend to outperform the S&P 500 and cyclical groups with betas over 1 in that type of environment. So, should you aggressively buy utilities when yields plummet and sell your utilities when yields rise? Not really, unless you want to underperform or you like to leave cash and dividend income sitting on the table. I decided to examine absolute sector returns in different interest rate environments using a few different methodologies. First, one of the more straightforward ways to determine whether we're in a rising or falling yield environment is just to throw up a simple moving average over treasury yields, right? When the yield is above the moving average, we're in a rising yield environment, and the opposite is true when we're below the moving average. So I did this using both the 50-day and the 200-day simple moving averages plotted on the 10-year US Treasury yield. I then calculated the annualized returns for all of these sectors on days when the 10-year yield is above the 200-day versus below the 200-day. Same for the 50-day. Here are the results. The first thing I'd like to point out is right at the bottom of my table. And some of you may find this very surprising. I didn't. For the 50-day moving average test, which excludes obviously the first 50 trading days in my data set, so I could calculate the average, that was back in the late 90s, the simple buy and hold return from the S&P 500, well, it's 10.7% annualized. That's if you just bought it and held over the entire period. However, if you only own the S&P 500 on days where the 10-year Treasury yield was above the 50-day moving average, your annualized return would have jumped all the way up to 22.3%. Compared to a paltry 0.1% annualized return on days where the 10-year yield is below the 50-day moving average, right? For the 200-day moving average, the buy and hold return is actually higher at about 12.5% annualized for the S&P 500. Once again, though, most of your market returns come from days when yields are above the 200-day moving average, not when yields are trending down. I think a lot of people think that rising treasury yields are bad for stocks, but that is a complete myth. It relates back to what I said earlier. When yields are falling, it's often a sign the market is concerned about growth and recession, which is a bad time to own stocks. Now, look at the individual sectors here, and in particular, that difference column, which shows the difference between your return from owning each sector on rising yield days versus falling yield days. A positive number here would indicate returns are higher when yields are rising, and vice versa. For the 50-day moving test, those allegedly long-duration tech stocks have actually produced negative returns when 10-year yields are falling. So too, energy, financials, and industrials, all cyclical groups. They benefit from a stronger economy, which is signaled by, guess what, a rising 10-year Treasury yield, growth. For the 50-day SMA test, only 4 of the 12 ETFs on this table actually show higher returns on falling yield days compared to rising yield days. And for the 200-day test, only 3 of the 12 ETFs show higher returns on falling yield days. Now, for the 50-day test, those 4 falling yield beneficiaries are communication services, real estate, staples, and utilities. For the 200-day test, they are communication services again, real estate, and utilities. For communication services and utilities, one important point I'd bring up is that we have a far shorter data set for these ETFs than the others. Now, we only have data back to 2018 for communication services and November 2015, late 2015 for real estate. So this distorts the picture significantly for reasons I covered earlier, the different regimes. Second, except for the 50-day moving average test on real estate, all of these falling rate beneficiaries still produce positive returns when rates are rising. Also, I suspect that for utilities and staples in particular, some of that underperformance in rising yield environments has to do with the fear and greed trade we outlined earlier. At times like 2007, 2008, when yields are plummeting, you have some people running for defensive, low beta sectors. In contrast, in strong yield uptrend environments like 2009, when the economy is recovering, they're probably favoring more cyclical or growthy sectors like industrials, energy, or even technology. One more point. In case some of you are thinking, why not avoid utilities when yields are above the 50-day simple moving average and buy them during falling yields environments because the annualized returns are so much higher in those falling yield days? Well, as I said a couple of minutes ago, that's a really bad idea unless you love to leave capital gains and income on the table and you just like to underperform. Take a look. This slide shows you that if you simply bought $100,000 worth of that Spider Utilities ETF at the beginning of your data set back in the late 90s, you'd now be sitting on about $765,221 worth of total investment. So a profit of over $665,000. Simply buying and holding, right? Now, if you invested only on days when yields are falling, your annualized daily return would be higher, but you'd only be in the market on a little over half of trading days, 55% to be exact. So your $100,000 invested in the late 90s, well, it would have only grown to about $478,878. You're leaving a little over 43% of your total profit and returns on the table because you're not fully invested that 45% of the time. Now, even worse, the 50-day SMA signal produced an average of 34 trades per year. The median regime change for the SMA, well, it only lasted about 4 trading days on median. That's a lot of trading costs, and you would end up exposing you to short-term capital gains. And also remember, if you're in the utilities only 55% of the time, that means you're foregoing almost half the accumulated dividend income over the years because you're not in the market for a lot of those dividends, almost half the time. So we covered a lot of ground today, but let me summarize with this. A lot of times the mainstream media in particular likes to promote these naive rules of thumb. They seem logical and they're repeated so often they're held up as undeniable market truths, like they're carved in stone. And it's pretty easy to concoct a compelling emotional narrative about the macro picture involving Donald Trump, the Fed, the new Fed chair, stagflation, and rising treasury yields being bearish for utilities or tech stocks. It's certainly a lot easier to do that than the real work of looking at fundamental territory or footprints for a particular utility stock and understanding how they might benefit from data center construction in their region, rising industrial demand in their region. And it's a lot easier than doing the work my colleague Roger Conrad has been doing for decades, understanding an individual utility's relationship with its state regulators. You can dismiss all the work of fundamental analysis, economic analysis, or even a comprehensive understanding of the technicals, something I love to do, the charts of various stocks and whether they're showing relative strength or weakness at any given time. The media wants to distill everything to a chart of yields and rate-sensitive sectors versus not rate-sensitive sectors, or some sort of politics-based stem winder of a story. Only one problem. That's not how it works. And these narratives can cost you some serious cash, as I just showed you. Rates are a bit player in determining a relative performance of various sectors, and the relationships are not consistent across market regimes. The data suggests that many of these moves have little or nothing to do with yields or competition from higher treasury yields and rates. It has everything to do with the business cycle, risk on, risk off, market regimes, right? And earnings. And many times when the media tells you rates are spiking or plummeting, they're really just hyping up background noise. Now this chart shows daily data on the 5-week change in treasury yields, quoted in basis points, since the end of 2024, just the last couple of years. The purple, red, green, and light blue lines represent the standard deviation bands based on a rolling 2-year look-back window that we talked about earlier. So for example, when the blue line rises above the purple line, that would represent a 2 standard deviation spike in 10-year treasury yields. Similarly, when the blue line is below the red line and above the green line, we're in a passive regime, a normal regime for rates. What's fascinating to me is that while I've heard plenty of talk this year about spikes in yields and the largely debunked read across to sectors like tech, utilities, and financials, we really haven't even experienced significant velocity in rates this year at all. Indeed, we haven't exceeded a 2+ standard deviation move higher in 10-year yield since early 2025, last year, more than a year ago. We have seen 2 brief rises into moderate yield rise regimes this year, as well as 1 very brief dip to a moderate fall regime. For the most part, despite what you may have heard, we've been in a placid yield regime. So I hope that you enjoyed that and found it interesting. Please feel free to drop me a comment below. And I am still offering 30-day free trials to the paid tier of this service for new readers via the link below this video. I also appreciate it if you drop me a like and subscribe to get these weekly videos for free every Sunday afternoon. Helps a lot with the algorithms. Again, thanks for listening. I'll be back next Sunday with a new deep dive.